Welcome to this bite-sized video tutorial where I'm hoping to demystify the accruals concept. We'll introduce the definition, we'll work through a numerical example, and then we'll learn some shortcuts that we can use to help us answer an accruals question in the exam. So let's go. Now, at its core, the accruals concept is all about ensuring that transactions are recorded in the correct financial accounting period, irrespective of cash payments and receipts that are made in the year. Therefore, we must show in our statement of profit or loss the expenses truly incurred during a year to generate the income that is truly earned. Now, this is sometimes called the matching concept. So, the accruals and prepayments in our financial statements will arise from year-end adjustments caused by the accruals concept. Now, accruals and prepayments are the adjustments that will apply to expenses, and deferred income and accrued income adjustments are the adjustments that will apply to income. Now, in this tutorial, we'll be focusing on the expenditure adjustments, so the accruals and prepayments. Now, we need to ensure that the correct expense figure is recorded in our financial statements, and therefore it might be necessary for us to make an accruals adjustment or a prepayments adjustment where the cash paid for the expenses does not equal the expense that's relating to that particular period. Let's start off by thinking about the accruals adjustment and how it might arise. If you have a year end of December 2019 and you've incurred a telephone cost for the month of December 2019, just because you haven't paid for it doesn't mean you wouldn't recognize it in your financial statements. This is where the accruals adjustment would come in. What we would need to do is record an extra expense at year end by posting an accruals adjustment. So how do we post the accruals adjustment? Well, this would be via a double entry whereby we debit an expense category in the statement of profit or loss, and we would credit an accrual in the statement of financial position. You must realize that an accrual is a liability, typically reflected as a current liability within our statement of financial position. Now, the opposite is true for a prepayment adjustment. As the word prepayment implies, this is a situation where you may have paid for an expense that you haven't yet incurred. Say, for instance, you're paying rent and you've actually paid rent in advance for 3 months. Now, if your year end is December 2019 and you paid the rent in December 2019, but it covers a 3-month period, the fact of the matter is you've prepaid for 2 months that actually relate to the following year. So we would need to make a prepayment adjustment. How do we do this? Well, we would do this by reducing the expense at year end and posting a prepayment within our statement of financial position. So a prepayment adjustment double entry would be to debit a prepayment in the SFP. Now this would be an asset, typically a current asset within the SFP, and you would credit the expense, thereby reducing it. To put this into a little bit more context, let's look at a numerical example. So in this example, a business has started trading on the 1st of January 20x0, and on that date, they've also entered into a telephone contract paying bills in arrears. Now, the word in arrears simply means that payments are being made at the end of a payment period. So here it says payment in arrears on the 2nd of the following month. This would mean that the telephone bill for January 20x0 will be paid the following month on the 2nd of February 20x0. So if we were to assume that line rental is fixed at £20 per month, by the end of the year, the business is making 11 lots of £20 payments, because technically the bill for December 20x0 will not be paid until the following year in January. So how do we go about accounting for this transaction? Well, each month as the payment is made, you would be posting a telephone expense into your general ledger. The cumulative position would be that you're paying 11 lots of £20 payments, so you'd be debiting a telephone expense, £220, and crediting a bank account, 220 for the payment that's been made. Now, we've just said that the accruals concept is all about accounting for transactions as they are incurred, irrespective of cash flow movement. The fact that we haven't paid the December bill doesn't mean we don't account for it. Instead, what we're going to do is we're going to post at year end an accruals adjustment. We do this by debiting a telephone expense, £20, and crediting the accrual, £20, as a liability, thereby showing that that £20 will be due and paid in the following year. Now, if we were to translate these dual impacts into a T account, how might it look? Well, the first illustration there is of the telephone expense account. You will observe that we are posting the cumulative £20 payments being made for 11 months as our first entry. We are debiting the telephone expense, and we would have credited the cash or bank account. The second transaction that you see within that ledger is for the accruals adjustment. The accruals adjustment is being posted as a debit to the telephone expense account, thereby increasing it, and you would be crediting an accruals account in the SFP. And you can see that this is posted on the credit side, thereby representing a liability, an amount that is due by the business in the following year. Now, assuming there are no further entries to post, we can balance off these T accounts. And we would do so by realising that the total telephone expense ought to be £240 for the year in respect to the telephone bill. Now that makes sense because that would imply 12 lots of £20 line rentals for the 12-month period ended December. As the accruals is a liability, you would balance off this account ready to carry forward that £20 into the following year. Now let's take it a step further and think what would happen at the beginning of next year when that £20 payment is made. Well, it's all about reversing that entry in the following year when the payment is made. So over onto the next page, we now have this scenario being extended for the following year. So post year end in 20Y1, the £20 telephone bill is going to now be paid in January 20Y1. However, it related to prior year. Now, at the point that the payment is made, the bookkeeper would certainly post a debit to the telephone expense and a credit to cash. However, this payment had been accounted for as an accrual last year. Therefore, one of the first things we must do in the following year after we've posted an accrual is to reverse it. Now, the reversal journal is simply the opposite of the initial journal that would have been posted in the year when the accrual is made. Remember, in the previous year when we posted an accrual, we debited the expense, we credited an accrual. So, to reverse it, we're going to be debiting the accrual and crediting the telephone expense. We can see this in the form of our T account. Remember, the bookkeeper will be posting the payment of £20 being made first by debiting the telephone expense and crediting cash. When the accrual needs to be reversed, we are debiting the accrual expense and we're crediting the telephone expense, precisely what we've just seen in the journal above. We're now at a position to continue recording the remainder of the telephone expenses being paid as normal. Let's think about a shortcut method that you could use in the exam to answer an accruals question. The most typical question in your exam is going to get you to think about calculating the statement of profit or loss expense figure by thinking about accruals perhaps brought forward and accruals that need to be posted at year end. How can we derive that statement of profit or loss expense figure without using T accounts? Well, let's just think back to what we said about an opening accrual. An opening accrual at the beginning of the year actually relates to an expense that should have been included last year. So, at the beginning of the current year, we need to remove it. we need to reverse it. In any case, if you see an opening accrual, deduct this from your calculation. Remember, it related to last year. During the year where cash payments are made for a particular expense, well, they are included in our P&L. We typically debit the expense and credit cash, so you observe in this shortcut that they're added. Now, at year end, if you still have an amount that's outstanding and due for a particular expense that hasn't yet been paid, we make an accruals adjustment. And we do this by debiting the expense and we credit an accrual ledger. So, any outstanding amounts that haven't yet been paid are added on. Now, the summation of these should give us the P&L expense charge for the year. Let's apply this shortcut to a question that I've taken from the Institute Question Bank. Now, you'll see that the requirement here is to derive the charge for the electricity in the statement of profit or loss with our year end being 30th of June 20x1. Once we've read the question, we observe from the detail above that there is an opening balance for electricity that was accrued at 1st of July 20x0. In other words, it was the closing accrual at the end of last year. Remember, our year end is 20x1. This therefore means you have an opening accrual, and we've just said that applying our shortcut method, any brought forward accruals are to be deducted. So we're going to show that as a deduction. During the year, various payments have been made. Oftentimes, the questions will have loads of dates and it could feel overwhelming. The key thing to realize is that any payments made during the year do need to be added. Okay, so any cash paid, we're going to add. We notice there are 4 payments made during the year, and the summation of these 4 payments gives us a total of 3,060. We can add that on here. Having dealt with the cash payments, we can now think about whether or not there's a closing accrual for the year end. Now, in this particular requirement, we ought to spot a couple of things. That the very last payment, for instance, only relates to the 3 months 30th of April 20x1. With our year end being 30th of June x1, it's apparent that we do need to think about the payments for May x1 and for June x1. So we ought to have an accrual for 2 months of the year where we don't really have a payment that's been made. Now, the very last sentence says that post year end on the 1st of August, a payment of £840 was made relating to 3 months 31st of July 20x1. We've already said that 2 months worth of payments do need to be accounted for in our current year, May and June x1. This payment of 840 actually relates to 3 months. So what we are going to do to calculate our closing accrual is take the 840 and we pro rata for 2 months out of the 3. This gives us a rough estimate for the accruals that should be included for the months of May x1 and June x1. This gives us 560, and when we cast down, we get a total figure of 3,320, which is option B in this scenario.
So there you have it. We've gone through the definition of the accruals concept, we've looked at a numerical example, and have also applied a shortcut method to an exam style question. I hope you found this video beneficial.